as usual, risk disclaimer. So take a moment to read through that before we carry on. No, that's long enough. All right. So what are we going to discuss? Well, firstly, for the newcomers, I'll introduce myself really quick, just a little bit about me. What we're going to discuss then is we're going to look at possible market movements. We're going to use that to plan our entry and exit strategy. I'm going to touch a little bit on risk management in relation to this specific point. And then obviously we'll have a Q&A at the end. There will be charts included into this whole webinar, and I will be interactive. So, there's a question box. So for those that are in the webinar, keep your toes on. Right, so about me, who am I? Like I said, my name is Mike Rotting. I am 36. I was born in the Netherlands. I'm currently in Greece, married to a wonderful wife with a beautiful daughter. I've studied international business studies at Deltion through a Cambridge system, Cambridge, England, but in the Netherlands. Was kind of bored along the way, so I stumbled upon what was then binary trading, which felt a little bit too much like gambling, which diverted me to Forex. Like most of you, at the start, didn't really go that well. First account, demo account, trading this, trading that, following this. Oh, that works great. Switching to a live account. First live account, about 3 months, and then I got greedy, and obviously, like most of you, fell into that trap at some point. Did that once or twice, and eventually, I thought maybe I should stop listening to all these self-proclaimed gurus and just try to figure out what the market actually does. Something clicked, started working out, and since then I've been consistently making profit on a yearly basis on my retail trades. Since then, a long period has passed, a little over 15 years, and it got me to a point where I could rotate out of the Forex day trading basically, and put my allocation a little bit different, which brings me to what I do. Apart from these webinars, clearly I do mentoring on Forex retail trading, and apart from that, I am working with a international company where I look into offshore investments, general investments like multi-asset investments, also other financial planning, and I am currently following the course for my financial advisor certificate through the FCA, CISI. That's me in a nutshell. So yeah, carrying on. So possible market movements. So what do we mean by understanding possible market movements? Well, first of all, I assume that this being part 2, you've done part 1 with me where we drew the technicals on the chart. So now we're going to understand how this chart is going to tell us what the market could do in 2 terms, in the short term and in the long term. There's different trading techniques that you can apply in different trading venues, and I listed a few very simple ones, more known ones. I know that there's also grid trading and all these kind of fishnet and all that. Not to get into that too deep because there's really no point. The point right now is, okay, so when we look at possible market movements, how do we look at that in the terms of, well, riding the wave? When we discussed the trading, we're small fries, each and every one of us. Right? Even if you have a $300,000 account, you're still a small fry when it comes to the investment industry, when it comes to the Forex markets, when it comes to the securities, right? It used to be a while ago, $4 trillion a day being moved around. So 2 up, 2 down. That has obviously grown since then. Retail trading has become more accessible. People have become more educated, so it's a bit slower. This is why the day trading will come back to why you hear people say day trading is dead. So riding the wave is something that we need to understand as a small account. We're not going to be influencing the market. It's not us. We're not putting in massive amounts. You're not going to beat the market because you're not smarter than the market. Even when you are experienced, you cannot beat the market. The market will do what the market does. What we do is we ride along, we follow the wave, and that can be up and down. Now, it doesn't mean that sometimes you can't trade against the trend. This is something completely different, right? But in general, you just want to go with the flow. Don't try to, think like, I'm going to beat, everybody's going to do this, or I'm going to do that. And generally, everybody thinks that, so you should actually do what you think everybody does, because that's exactly the opposite of what everybody's doing, generally speaking. But what you want to do is just, put yourself down and understand and accept the fact you are not influencing anything. You are not going to be beating the market. You're there to just, go with the flow. Two popular techniques are scalping and day trading or intraday trading. Scalping is on a very small time frame. What people don't understand is that the true nature of scalping is very, very bad for retail trading. And I'll explain that why. If you look at the scalping that actually happens, if you look at, for instance, Wall Street, where it is an issue that there are scalpers. These are supercomputers hooked up to the stock exchange, literally across the street with a direct line. And they're machines that do about 700 trades per second. And they literally take 1 or 2 micropips. Now, you need to understand that that's impossible to do as a human, but that's actual scalping. Now, the retail version of scalping is I go on 1 minute time frame or 2 or 5, and I go in, and 5-6 minutes later I go out. The general problem with this technique is that you need to have an extremely high success rate because of the risk factor. You generally, what proper scalping is, you go in 2-3 pips, you go out, no more. The problem is the downside. You don't go out when you drop 2-3 pips. You let it run. So you're taking a much higher risk of money that you're willing to make than willing to lose than you're willing to make per trade. But this is the thing. You do a absolute metric ton of trades, high volume at 95+% win rate. Anything under that, you're going to actually start going downward. So it's a very stressful, very intensive style of trading. It's not, it looks very tempting because in our mind, when we start, especially as starters, small time frame, okay, I go in, it moves straight away, it's in the green, and I close my trade, boom, I got a few dollars. The reality is you just risked way more than you're willing to make, and that doesn't make any sense. That's very bad, risk management. It's very bad trading. And you're not doing it in a volume big enough that when you do lose, which you obviously will, you're not going to recover from that easy. Remember, for every 9 trades you win, 1 loss not voids half of it, if not all of it. Right? You need to win 9.5 out of 10. Right, 95%. So this is very important to understand that scalping, it might not be the best technique for you unless you literally have nothing better to do, which I doubt. Day trading or intraday trading, whichever the way you want to look at it, they're similar but slightly different. But the reason that you hear a lot of more experienced actual traders say day trading is dead has to do with volatility. The volatility we know today has significantly dropped compared to the volatility we used to have, think pre-2008. One of the big key contributing factors is obviously 2008, where people, even still to this day, the trading habits have simply just shifted. It's less aggressive. It's not for the bigger parties, but especially in retail trading. Obviously, a lot happened. There was the problem in 2012. Yeah, February 2012, where the Swiss, bank, correct me if I'm wrong on that date, where the Swiss bank took out the ceiling that was artificially holding the euro versus Swiss up. When they removed that, several larger retail brokers collapsed overnight. They literally went default in less than an hour. And this is where most of the rulings, if you're in Europe, from MiFID come from. This is the reason what's there. This is why the FCA, Harman said almost all regulations rulings came out of that. And because of that, it also cut down the amount of risky trading that retail traders were doing. So there is more of us now than there was before, and the amount of trades volume is increased, but it's very conservative. They're not aggressive positions. It's not, very. So the lifeblood of traders, which is called volatility, is a considerable lower amount, a lot less than it was before. And that makes sense, right? Think about this for a second. You have more volume in the market, which means that you need even more volume to make it volatile. Right? I have $1 going up and $1 going down. Me throwing $2 in the up means that it skyrockets up because it's 3 times the volume of the down. Right? It's very easy to change. But when you have, instead of 4 trillion, $8 trillion, and there's now 4, we now need 4 more just to break even. So what used to be the entire market is now both sides. Not exactly, don't go, I think it's around 5 or something, 5.2, but that's the point. Right, so more volume. So it doesn't mean that day trading is dead. It's just dead compared to the volatility we used to have. When I remember pre-2008, luckily I got last stretch of that. Yeah, the pound yen would occasionally just throw out 1,000 pips on a day, 2,000 on a good day. Your US dollar would still move quite a considerable amount. If you look at nowadays, it's not really anywhere near those levels. That's more like a week now. So it basically slowed down by a fifth, which is why they say day trading is dead. It's not. It's just less, which means that again you're doing more effort for less return. And at the end of the day, that's what we look at, right? Return. But these are all short-term trading things, right? They're all within a week. Right? Scalping, riding the wave is just more, you do that along the side. That is within the shorter time frame and any of the shorter time frames. Scalping is only in the minutes. Day trading, okay, obviously, a day chart, but that is actually a small time frame, right? You're trading within the 24 hours or 48 hours, right? The long-term trading, the most popular or most known one is swing trading. It's also the most risky one, right? Because you're predicting the turn of the market, which means you go in, if it's, let's say it's trending down, you take a buy, a long position before it turns. You're not waiting for price confirmation or consolidation phases or doji formations or whatever you're looking at. You see a market at a certain price, it's getting certain technical levels. You want to go in. So you take a buy. And every 20 pips it goes further down, or 50 or 100 or whatever it is, you take another buy. And you keep stacking them up as the trend keeps going down and down and down. And eventually, you'll end up with 10, 15 different trades. They're all buys, right? But the first 3, 4, 5, 6, 7, 8, 9 are all negative. And as it starts climbing back up, you're coming back up. And this is fine with one problem. You need to have the equity in order to do that. Because you have massive stop losses, because you're thinking about, future predictions. But you first need to ride the wave all the way down. Once it starts turning around, yes, you catch up and you make a considerable amount of profit. But this is not something for a small account. Right? Your capital, I discussed this, your capital determines what you can and can't do. Also what you can and can't trade. So what does this look like in a chart? So I looked a little bit at the technical things. Let me just get the question box out. There we go. So here's one important point. So this is the Euro US dollar. It's on a week chart. Very plain, quick, support resistance and the current trend. Right? Easy switch, remember, from part 1. You use this to just get a clear cut view, and now we have the static back end. All the wicks and everything else is just static, it's noise. Now, obviously this doesn't tell us too much when it comes to what do we do, right? We know it's moving up. It's had a little bit of a run, which it pulled back to this horizontal level, and it bounced basically off what we now know is the bottom of the trend, most likely, which is about, a normal distance, but it's back at the previous high. So now you get it, which is the bottom of this and it's top of this, right? It's right this line here. But for a weekly resistance, the top is more important because if it wants to push past this, it will go there anyway, but then it will stop there. This will probably be the first breaking. And we discussed this, right? Everybody that went in on a buy here will have a take profit around here, which means that there's also a lot of sell orders somewhere around this area, the previous high, probably around the top of the wicks. So once these trades start going up, a lot of take profits, a lot of buying pressure falls away from the market, and a lot of sell pressure starts building up in the market. This is why you see these weird spiky reversals all of a sudden. It's just that flip of positions closing and opening. And what happens then is that it depends on the situation why it got there. And this is where fundamental analysis comes in, right? Is there a reason for it to push past this point? Is it fundamentally justified for the price to go higher versus the other security, right? Versus the other instrument, right? So for instance, the euro versus the dollar, is it valid that the euro goes over 122? 124. Now the question is, can it go to 125, 126 again, compared to the dollar in the current state? Well, the whole pandemic, maybe. There's geopolitical, there's a whole bunch of little factors. But right now, what we care about is like, okay, so we see it moving up right now. We see a trend. We see that it didn't break through. It came off of this balance. It's back at this high. We're at a Wednesday. So what is important for us to know is where's it on Friday? It could be here, but is this a trade you want to take? I mean, you basically missed the start, right? The start was here. So you're already about 420 pips down. If you go into the trade now, you're trying to make this trade happen, which is 240. The problem is your stop loss. And this is where entry and exit comes in. How do you use this information to determine your entry and exit? So remember that we color code our analysis, right? So day, we have the golden color. And then when we go to 4 hours, which is the lowest I did for this example, we got purple. Now we have a good overview of everything, what's going on, right? The trend on the week, the trend of the day within the week, the trend of the 4 hour within the day within the week. Right? You go on a smaller time frame. I'm not going to trade the day trend on a 4 hour chart. Right? That makes sense, I hope. So I look at the smaller time frame because my entry is always going to be small time frame. Yes, you can do an hour. Yes, you can go even lower. The same concept applies. Just keep going backwards. Here's the thing. How do we use this information to determine where our entry is, where our exit is? Well, first we need to understand what possible movements can the market make. Well, let's dig into that scenario. So we stay in the 4 hours because we always do our opening in shorter time frames. So right now, as we can see, we're looking at a very basically jagged upward movement. It went past the previous high. Do we see anything special in the sense of a candle formation? Not really. We had the breakthrough, which is the day chart, right? The day resistance, it went through that. That was yesterday, because if we go to a day, we see where that was. So yesterday, it decided to break through and close outside of its resistance that it bounced into twice, 3 times. So the most likely scenario of what it wants to do is continue upwards, right? So the most likely scenario would be that into something like that, into until it bounces into the next line, which is somewhere over there. But that is not the only thing it can do. We're not factoring in fundamentals. Obviously, during this timeline, keep in mind that if there's news announcements along the way, they can significantly shift how this works. But you don't need to know those in order to make an assessment of, hey, what are the possible options that it can do? So is this just one scenario? Yeah, in a sense, but it can also do this into correction and then jump in here and then go up, right? Or do this, which is unlikely, but for argument's sake, let's say it bounces off of this first, does a little bit of horizontal movement and then goes up. So that's scenario 2. So let's make scenario 2 gray, because we don't like scenario 2. But scenario 2 will still be a profit for us in the end, because then it follows purple. Scenario 3 is that from current price, it does do this and then continues upward instead. And then bounces off of that. Do we care about that? No, because it's the same point as this. So this whole scenario, we don't care if it goes a little bit further and does this into this. We can even leave it like that, saying like, okay, it's going to follow this line, but it could bounce off, right? That's a scenario that can happen. But we also need to consider, what if this is a fake? It's been confirmed closing outside, but what if today, at the end of the day, it decides to correct down? Because the entire day, it's done absolutely nothing. It's actually down considering the start of the day. We can confirm that we have a red candle. It tried to climb, it went down. So after it broke through the line yesterday, it seems that there's absolutely no real pressure to go up. So what is another scenario we have? Well, is that it drops all the way back down. Now, here, you can have scenario 3 happen where it goes even further down. But again, we don't care about this one. And the reason we don't care about this is that because we're talking about this market situation, if I'm all the way down here with a buy, you should have been out of it. Because our entry is now. We're at the bottom of the trend. We followed these points, right? So we're following this here over this, and we're just extrapolating the data, which is where it is right now. And it's struggling, it's trying to stay above this line. So right now we see the indecisiveness. So that's an indication for us, obviously, like, okay, maybe it's not the time to buy, but this would be the position to buy if you are going to buy. And the reason is very simple. If you would buy now, then this is your market price. And we're going to make that green. And we're going to make it, I can't make it dotted because then it becomes unclear. So I'm just making it a really thick line. Okay. So this is our entry possibility. You're at the bottom of the trend on the 4-hour. You're close to a resistance on the day. So what do you do as a stop loss? We know in the scenarios that it can go down, it can bounce off of this line and go up, or it can just go up. I don't care about anything in the purple side. And the reason I don't care about the purple side is because I've never heard anybody complain about more money. Winning's winning. I don't care if it happens now or exactly as I drew it. I don't care if it's in the next hour candle. I'll take it. What I don't like is losing money. That's the side I'm trying to control. I'm pretty sure most of you will agree. Except for a few sadists out there. Right? But where is your stop loss going to be? Well, ideally, you want it below the previous low. But what's our problem here? Well, it's way too far. And the reason it's way too far is because our potential profit point, the initial one, is the top of the daily channel. We're halfway there. We're going underneath it for the stop loss to have the most secure point. But our take profit would be somewhere along this line. Right? So if it bounces off of this and nips it, that's fine. But this is an inverted ratio. This is not even 1-to-1, right? If I go in here, my stop loss is now 160 pips. My take profit is only 120. Is that a ratio we want to work with? No, it's not. Which begs the question, should we still be able to take this trade? Well, the question is yes, you can still take the trade. But it's looking very likely that the gray scenario number 1 might actually unfold very soon, which means that our new entry would be right dead smack there. Because whether I go in now or when it's over here, when it does this wick thing again, my stop loss will most likely be around there. Because this, remember, is a daily. The golden one is daily. As long as it doesn't close underneath this line today, most likely, it will go back up. And if it doesn't, and my entry point is here, and my stop loss is here, I still risk a fixed percentage of my account. However, my ratio of, so let's say we go in on the wick. I'm taking this wick as an example, and it goes back down. My stop loss is still going to be here. Now all of a sudden my ratio is mere 25 pips versus 150 pips. Slightly better ratio. Now you might think, okay, this is a little bit too tight. It might wick through. Well, we can check that by just going a little bit into the past and see the last time that it did those lines. Okay, here we are. Now out and fully back in. All right, let's go here. Okay, still same scenario. Here it wicked up, no down, it's not really relevant. Here it did. So it went down, hit that line, wick, miss, wick. Hard to tell if it went up first and then down and then back up, but so here it would have broken, here it would have, okay. So based on this history, let's say we'll move it down just underneath this scenario. Remember, current market price is right there. I'm gonna go here. My take profit is all the way up here. So based on this, I now know my entry point if I wait for the market price, going back to the current market, boom. I'm waiting basically for 20 more points to go in, ideally, and then I have a 40 pip stop loss versus a 150 pip take profit, which is 1 to 3, a little bit over that, which is perfectly perfect. 40 to 140, I'm okay with that. And I think all of you will agree. So we've now determined that our optimal entry point would be here if I want to buy. If you, however, feel like, well, I want to sell, which would be against the trend, right? Weekly trend is up. Daily trend, oh, why are you doing this to me? Daily trend, well, up. The 4-hour trend within the daily trend, it's also up. So taking a sell now is basically you're ignoring 3 confirmed ups. Now, if you do this on several different charts, you're going to sometimes see that in the week it's going up, but in the day it's going down. Because, right, here in the week, it was still going up, but in the day it's going down. It's still in an uptrend. Your initial drawing would have been something like that. But that was the first bottom and you didn't have any real peak to work with. And this looks extremely steep compared to the rest, and it is. So now that we have a new bottom where it confirmed bounced off, where you already went into a sell here and you would have cashed out, we can now confirm that this is probably a more likely scenario of the actual uptrend, which seems like a normal, angle. For the day, same thing. And then we go into 4 hours. And now we can actually start fiddling around, right? So I'm going to try and make it as big as I can so it's clear. I hope it's clear. I got to move this little thing out of the way. Right. So I don't care that I see a red candle. I never care about the color of the candle now. I care about what it's going to do in the next foreseeable future. And the next foreseeable future starts with a small time frame always. Because your trade, even if you're going to go long term, the trade starts as a short-term trade, technically speaking, but with a vision of long term. You always trade with the idea of this trade is going to continue on for a few days to a week to a few weeks. However, when I open it, I would prefer that it doesn't shoot into the red in the next 2 hours and just like, straight dies there. This is why your setup is, okay, well, perfect. If it wicks like this again, I will take it. I don't need to wait for any price confirmation. I will have the confidence that as long as it doesn't close underneath this line at the end of the day, I will take it. At the same time, you can take it now. You're still in a okay ratio with the same stop loss, except your stop loss is now bigger. Right? It's now 60 pips, and you're only making 120 pips. So what is the problem here is that, for those that follow my risk management, if you have a fixed percentage, let's say 5% of capital, your lot size has now significantly become smaller. And that also means that your profit has significantly become smaller. It's a knife that cuts on two edges. So the better your entry point becomes, the more optimal your entry point is, and I'm taking this wick into consideration that it does that, the better that entry point is, the bigger the lot size is with the same percentage risk on capital, right? Because the stop loss is smaller. And the stop loss should be determined by your technicals, not by a fixed amount. Please, love of God, stop doing that. Like, too many people that come to me have, I trade with 20 pip stop loss and 60 pip take profit. That's great. Good luck with that on Euro CHF. Right? Try trading the Turkish lira with that. Fixed stop losses don't make any sense. It's dynamic. A stop loss can be as big as you need it to be. It doesn't have a value until you put a lot size on it. Right? 100 pips is a number of pips. It means nothing. But if I make it a micro lot, it's $10. If I make it a mini lot, it's $100. If I make it a standard lot, it becomes some money that I'm actually interested in. Right? But you have to grow to that. I know most of you won't be able to trade on those lot sizes, so you'll be trading with micro lots and mini lots most of the time. So what's important is that the more optimal your entry point is with a fixed amount, the better it is that your take profit is going to be. Because your take profit, the difference between entry point 1 right now and entry point number 2, somewhere around here, is a grand total smidgen of 15 pips. That's it. However, that 15 pips cuts it off from here, but adds it to here. So you're not going down 15, you're going up 30, because you're going down 15, which is 15 pips less risk, which means that your lot size increases, which means that your 15 pip increased take profit also increases because the lot size increases. It's an exponential game. And for those that don't understand that, trading on a fixed lot size is not good. Because if you do an interest-based system, as you're losing, and I always care about the losing part, I don't care about winning. Right? Winning money is fine. I don't care how much it is. The more, the better. The side that I'm trying to control is the losing side. Believe you me, you will have losing streaks. That is normal. That is part of the game. So having this little entry point scenario, like, okay, you already indicated several entry points with this. If I go in now and it goes down to here and it goes up to there and then goes up to there, boom, that's profit. My trade worked fine, as long as it doesn't do scenario number 3, because then it hits my stop loss, which means it breaks through this line. Scenario number 1 is I go in now. That means that I accept the fact that I'm going to have a slightly less lot size. I'm going to have this as a down draw period, and then it will go up. Another idea, another example is, the only time that this one is better than this one is if in the next few hours it decides that, you know what, nah, I'm good, turns around and just goes that way instead. Right, this candle, can we get to see? It opened at 8. Where's the market time? Oh, it doesn't say here. Okay, doesn't matter. So whatever this market time is on, this started at 8. I think it's the same time as mine actually. So this one's only been open for half an hour. It's a 4-hour chart, so we got another 3.5 hours to go. If I go in now and this thing flips up, I'm good. The ones that are waiting for it to come down here first, not. This is a factor people keep forgetting. Sometimes it's okay to go in early because you need to consider how can it develop. So let's look at an hour candle. Okay, been getting down for 3 hours. This is a little bit of a correction of this one. Okay, it fell dead, it pushed down a little bit. Okay, but this is the wick that we were looking at earlier. That's just somewhat of a scuffed doji. Okay, it didn't reach the previous, oh no, it did reach the previous high, just in a wick and then went down. So it's trying to, but it's not quite getting there on the really small time frame. So it's okay if it, sells off a little bit just for some people to buy in. But in my position, I'll just probably go in now. I don't care if it goes into a down draw for a bit. I'm going to go with scenario 1, and it either does that, this, or this, and I'm even okay if it goes like this. It just means I'm going to go downwards, which means that you will have the better entry point than me. Your trade would be better. But we both win the trade in the end of the day. And we both lose the trade in the end of the day if it does this. But statistical probability has taught us that it is already pushing upwards. So the most likely scenario is a positive buy trade. For those that are doing very small time frames, let's say M5, you're selling now, obviously. You're trading this sell, and the second it flips, you're closing it. I don't do that. I don't like small time frame trading because it's very short-sighted, and the market can flip like that. There is no real trend in small terms. It's only very temporarily. For the next 10 minutes, it'll do one thing, and the other 10 minutes is going to go the other way. Very rarely are you going to have a consistent run. So you are going to have to go in, out, in, out, in, out. You don't trade the small time frame in order to trade. I'm going to go in and then I'm going to monitor it for the next 5 minutes and then maybe yes, maybe no, and then switch it into a day trade. And then don't do that, please. I know some of you do. Don't be offended. Just don't. Just stop. Start trading in an hour. It's still fast enough. You open it, you set up your stop loss, you set up your take profit, which you've determined pre-opening the trade with your technicals. You calculated your examples of what directions we can possibly go. Obviously, we know the market cannot go that way. Sometimes we wish it could, but it won't. These are the only scenarios that can happen. Yes, and obviously a breakout that way or a breakout this way, but breakouts are usually based on either something really big happens politically or something really big happens on a fundamental basis. We're not covering fundamental. I didn't check if there's any news announcements right now or in the next hour that can determine how this trade candle develops. You have to factor that in still as well. But we're focusing on the technicals right now, right? So now we've determined what possible scenarios we have. We have 2 possible entry points with 2 possible profit points. So our exit strategy is obviously our take profit, but there's a few scenarios. For instance, scenario number, let's say 1B. We don't want to lose a winning trade. So there's a few points to that. So let's discuss those. So we plan the movement ahead, right? We read our chart. We understand what our variables are. So what is building on your winners? Let me elaborate on that one. Thank you, Gassi. So there is a news announcement in 20 minutes. So that's why probably it's a bit static. What's important to understand is that right now we need to determine what do we want to do, right? If you have 1 or 2 trades that are negative and 3 trades that are positive, One thing a lot of you do is something called marrying your position. Anybody ever heard of that term, marrying your position? Yeah, see? All right, so marrying your position means that people like to tend to hold on to trades. Building on your winners means that if your trade is developing correctly, it's okay to take a second position or even a third one. And this is where the question from short-term to long-term trading comes in, because when you're a short-term trade originally, let's say a day trade, right, 48 hours, 24 to 48 hours, that's what your setup was. But now it goes up and it goes here, and it's still very strong incentive to buy. What do? Well, you buy up, you go here, you take a second buy right there. So now we have trade number 2 going in here, and here's where the fun part comes. The stop loss of the original one, and we're going to make that a different color. Then we're going to make a dotted line like that. Let's make that bright red. The stop loss of trade 1, so this one. So let's say we're going right now, okay? The stop loss of this one goes from here to here. You secure your entry, right? We're in scenario 1 right now. We're over here. We do that with shapes. No. Right, so let's say this happened. We're now in this scenario. It pulls back. When you're in this scenario, you take your initial take profit, which is your initial entry, which is right now, and your original stop loss was here, which was this line. What we do now is we take that stop loss and we secure to the previous high or entry. Why? Because it should not go past this point, right? We determined that this is what it should do. It shouldn't do this. But if it does do that, I want to secure my money. I should never have the scenario where a green trade this far in ends up here. And I know for some of you that's happened more than once. It's happened to me. All right, it's okay. But this is why that happens. Because a lot of you also have like, okay, I put it to here, but then what happens is it pulls back and it hits my stop loss and zero was a winning trade. Yeah, but in the end of the day, zero is not losing, which still means you're winning. Starting yet with a proper risk management, you only need to win about 34% of your trades. 33.33 actually. But it's not a perfect world scenario, so roughly 43% to 45% win rate is all you need. That's worse than a coin flip. And now you're thinking to yourself, how the hell am I losing then? Well, about micromanagement. This is one of those things. If you do this, you secure a trade that goes out at zero instead of negative, that was positive, is still a zero, which means you didn't lose any money. The only thing you lost is some time. There will be plenty of other trading opportunities. Suck it up, get over it, move on. And yes, I am very well aware that sometimes it pulls back, nips that stop loss, and then instantly bounces into your take profit. We've all seen that one. And I know how frustrating that is. But you can't, it doesn't matter if that happens occasionally, because if it's the exception and not the rule, and it is the exception of the rule, unless you're using the top losses too tight, because that's another thing. If your entry points are correct, that is going to be the exception instead of the rule. And what is going to happen next is that you're going to slowly, consistently start making profit. I only care about making consistent profit on a yearly basis, not monthly, because generally speaking, I say, let's say, factor in that your month is going to be 10 months of profit and 2 months of shit. 2 months, you're going to lose, let's say. If you have a year that doesn't lose any of the months, perfect. But factor in that from the 12, you're going to lose 2. Well, 1.5 technically, because the market's closed a little bit, but right, 2. By factoring that into your head, it sets you up to understand you are going to have a shit month at some point. But with proper risk management and proper entry points, you'll be fine. Now, the proper exit points is step 1. Secure your bloody entries. When we talked about the first step was we secure our entries based on the average daily range. And we're going to get to stop losses in a second. So now it pulls back, and now we want to build on our winners. We're over here. We have secured it. Now I want to secure it a little bit more, because what I'm doing is I'm adding another buy to my position. I got to change the line again because, you know, great system. Boom. This is trade number 2. And my stop loss from trade number 2, I'm going to use that one, is going to be here as well. So now I'm risking my profit from trade 1, which is still 0. But if it turns out for the right thing, I'm going to jump from here to here, which is another 70 pips for losing 30. 1 to 2.5. I'm okay with that. All right. So in this scenario, I am now winning trade number 1 for 120 pips, and trade 2, I'm winning for an extra 60 pips, 70 pips. And I'm risking no extra capital. And my exit point, well, that's my exit strategy, right? The bloody there, if it pulls back. Now, going back to scenario 1, if it goes this way, one of my exit strategies is if it lingers around this thing the end of the day and it closes literally on this line, I close my position. I will save myself a little bit of money because I want to cut my losses. But it depends, right? If that's only been a few hours open and you're kind of like lingering around, don't do that. But if it's been in underneath this, between these two lines for, let's say, a day or two, it clearly doesn't want to move. Find a different trade. Eventually it could turn. Yes, I know. Just take the loss. Just get something else. Don't marry the position, right? And build on your winners. This was the way you build on your winners. Okay, so risk management, stop losses, fixed, moving, and manual. So stop loss is fixed. I've already explained. It's the dumbest thing ever. Don't have a fixed stop loss for every trade, for every instrument. You cannot trade with, I trade with 60 pips profit and a 20 pip stop loss, because that is a 1-to-3 ratio. Yeah. True. However, here's the issue. And let me show you what the issue is. 20 pips, you said, right? Okay, so well, your stop loss is, oh shit, it's right there. It's within the range that it can move in a day. Easy. And your profit is 60? Okay, great. It's somewhere over yonder. Great. You're basically doing bugger all. It could easily hit your stop loss and go to your take profit. But let's take a different chart. Let's go to Euro CHF. If it loads. Come on. There you go. Right. Forgot about the gap. So I shouldn't have done that. There we go. So here, well, let's zoom out a little bit. What do we say? Okay, 20 pip stop loss, right? That's over. Oh, there we go. Now the market cap shows up. That's right here. And my take profit is 60. It's over here. Okay. Well, actually, for the Euro CHF, you might actually be somewhere, because the bloody thing only moves about 30 pips in a day. But if I go the pound yen, who's going to be able to tell me what's going to happen now? Anybody want to take a gamble on this one before the chart loads? Perfect scenario. Right. I go in here, I want to take a buy, or let's say I go in for a buy here because I saw this, for instance. I'm going to take a stop loss for 20 pips. Oh shit, we're already there. Oh crap, I need to zoom in. This is way too small. So let's say I go in on the start of this candle. 20 pips is it's right here. Well, bugger. So I got knocked out. My take profit was 60 pips, which is exactly the top in this case. Let's go to a day, shall we? Okay, let's see what these candles look pretty average. That's 80. That's 60. That's 80. 50. 50. This one is topping out because it's slowing down. Let's look at the red candles, right? Because we're buying. Let's look at the red candles on average. Oh, with wick, obviously. No, just body. That's 60, 60, 120, 100, 50. At what point do you understand 20 pips is not enough in this case? Ever? In any scenario? The only time that might be enough is if you're in this scenario, you have a perfect resistance here, which you don't, and you go in right here, and nope, actually that's already 60 pips, so you would be over there. Oh, look at that. Even then you get screwed. So that doesn't work. Don't work with a fixed pip. What you should do is always trade with a stop loss, yes, but your stop loss is determined by your technicals. And when we go back to this whole story, let's go 4 hours. Now let's go for a day, right? I go in on this scenario. I want my stop loss underneath here, ideally underneath here, but then I have to go for this whole trade. And I want to trade a little bit smaller first and then trade the way down and then trade the way up. That's the most optimal for me as a small account, because otherwise I would have to wait for here and somewhere in this corner right here and then trade the full length, because this is my entry for this trade. But we're not there right now, so I want to trade this, into that. 1, 2, 3. Trade 1, trade 2, trade 3. Close everything. Wait for consolidation. Trade 4. Right, that's my plan for this trade. Now, I go in here. My stop loss is not going to be here. It's not going to be here, which is your 20 pips. It's not going to be 36 pips. No, it's going to be somewhere over here. Give it a little breathing room so it can wick. Right, we determined that on our 4 hours, remember? There it is. Your trading is actually 46 pips. My take profit will justify the 46 pips because the take profit is 130. But you always trade with a stop loss. Now we get into the next point, which is a trailing stop or a moving stop loss. Depending on the instrument you're trading with or the tool that you're trading with LegacyFX, you can use the MT5. And the MT5 works as follows. From the moment you set up the trailing stop in points, it's not pips, points, so add a 0. If you want to trade at 150 pip trail, it's 1,500 points. What is important to understand is that happens from the moment it is 150 pips in profit, not from the moment you set it up. Other tools have that the second you activate trail, it will trail from current market price to whatever is minus that. So if you say 120 pips, it will always trail 120 pips from the moment you activate it. The best case scenario, what you generally want to do, best behavior, is wait for the trade to be about 30% to 50% into your profit side. depending on what the daily range is on average. If it's outside the daily range, so let's say the daily range is 50 pips. That is what average it moves over the last 6-7 days. We know that the average daily range is 50 pips. My trade is 70 pips in profit. I move my stop loss to 0 first and foremost. So, right, so let's say we're at the market scenario of 50 pips. So let's say this is 30, what's this, this is 60? Okay, yeah, perfect. So we're at this 4-hour resistance. What do? What we do is we take our stop loss and we move it and secure the entry. A little bit more to cover, your small expenses. If you have a broker with commission and stuff like that, you have to factor that in. Don't do exactly, the amount, but just a little bit, give it a little breathing room for swap and stuff like that. Right? So you don't want to pay one a little bit when you can go 0. Now, this is my distance to the current thing. Now it's 53. Now let's say the daily average movement is 40 pips. Rule of thumb I usually advise, or what I use, is 40 in that case, right? So if the average daily range of this candle, of this chart, if the average daily range is 40 pips, I take 40 plus 20% or 30%, depending on how volatile it's been. But let's say it's been stable, 20% more. So I take 50 pips trail. And from that moment on, I cannot possibly, no matter what happens, lose my trade. The only thing it does, it's going to hit my take profit or it's going to knock me out at somewhere along the way. And yes, I know sometimes it's going to spike and then pull back down, hit your trailing stop, and then go to the take profit. It's like, I could have won more. Yes, this is greed. You could have won more, yet you're complaining that you've won a trade. Like I said, there's no ideal scenario where you're always going to get 1-to-3 ratio in trading. That's why I say the actual win rate's not 30%. It's like 45. Because you're not going to always get that perfect X trade and then perfect. But this at least secures you from proper exit strategy by exiting pullback trades and not waiting to see, fingers crossed, hoping it doesn't dip into 0 again. Which the manual adjustment is in a scenario where if you can, because what you can't factor in with a trailing stop is if you let it running overnight and you forgot there's an announcement of news for something for like the Bank of Japan and you're in the pound yen and you completely forgot about that, and then in the morning you wake up and the trade's gone. Yeah, that could be in your favor or it could be negative, but manual adjustment is only advised if, apart from moving the stop loss to 0, that's manual, but if you have like the MT5 that we use with that they use at LegacyFX, Jesus, what you do is you set up a trail, and in this scenario we set 50 pips. So I set up 500 points trail. That means that the second the trade reaches 500 points or 50 pips profit, it automatically moves it to 0 and now just follows it pip for pip. But there's some brokers that I know that some of you probably trade with, or some platforms that don't do that, that work in the way that the second you activate the trailing stop, it trails exactly that amount from the moment you activate it, even if the stop loss is still in 0, in negative. So in those cases, you want to manually trade your manually move your stop loss to the plus, secure your entry, and from there, you set up your trailing stop. Now, manual adjustment throughout the trade is generally advised against if you're new. When you're slightly more advanced and a little bit more experienced, you're probably not going to do the other two anyway. You will be starting to understand when the market tends to move based on day of time and move your stop losses accordingly. But that takes some practice, and rule of thumb is you will still just secure entry and set a trail. You might just intervene a little bit with it in certain times of day when markets spike because of market openings, because of announcements, because of some Cheetos guy sending a tweet, or some geriatric donkey that we have now doing something weird. Right? These are things you have to keep in mind. Exposure, I want to touch on that very, very quickly. Exposure is very simple. Don't buy 10 euro pairs. It's very simple, right? Too many people's like, I trade. No, I spread my risk. I have 2 in euro US dollar for some reason. I have euro GBP. I have a euro CHF, which is a sell. And then I have a pound dollar. Like you're like way overexposed. Everything is euro, dollar, a pound. You have 5 positions of the euro. If one goes tits up, they all do. Spread it out. Generally, again, rule of thumb that I use, 2 correlated pairs at any given time. Right? So euro US dollar, euro GBP, GBP US dollar JPY, GBP JPY, Aussie dollar versus New Zealand dollar. Actually, yeah. Something like that. You now have it split a little bit. There's some natural correlation between pairs that move, but you know, you're not overexposed to everything is euro. Trade with multiple trades because you have a capital to trade with. Don't make a $2,000 account and then only risk $20 at a time and only doing one trade at a time, because then what the hell did you make a $2,000 account for? Or euro or pound or whatever, Bitcoins. Yeah, 2,000 Bitcoins, good job. But you get the point. Use the capital you have, which brings us to lot sizes. The stop loss, like I said, is a number. It doesn't get any value until you put a lot size to it. So rule of thumb I use is 5% risk per trade per capital. Trades against the trend, 2.5% risk to 3% risk, depending on how confident I am about the trade. And then there's some punt trades that I might take 2% trade risk. My lot size is then calculated based on my stop loss. Right? So in the scenario that we did, right, let's say here, we'll move the stop loss back to its original spot, which was somewhere around here, I think. 46, didn't we say? Yeah, there you go. Nailed it. All right, so let's take these 2 out because we don't need, no, the green one we need. The red one, no, the green one was the second trade, right? Yeah. Bugger, don't. I want to keep the big red one. Now, so let's say a scenario here. Let's take a quick scenario, and I want you guys to join me for this one. I'm going to open the question thing is open. Let's see who can understand this, because people always get stuck in this. So I go in right now. Remember, this is the FOMC announcement, 20 minutes. It's right now. So this is why. Hey, entry moments. Okay, anyway. I go in now at this market price. I want to have, okay, so let's say 45 pips for ease. My account is 2,000 euros, or 2,000, whatever that may be, 2,000. And in this scenario, this is the FOMC announcement, by the way, guys. Don't worry about it. So the 2,000 euros, I go in. My stop loss is 50 pips. What is the lot size to make that stop loss equal to 3% of my account? Who wants to take that one? $2,000 account, 50 pip stop loss. What lot size do I use to make it be 3% risk? Come on. Anybody who's willing to take this one? There should be a chat thing. Just type it in there. Nobody? Or is everybody looking at the chart? Right, Maxwell? Yeah, that's the amount. But how do I make my 50 pip stop loss, that value. So yes, the value is $150, right? That's 3% of my account. So what is the lot size on a 50 pip stop loss? Anybody? It's 3 mini lots. So I would take this trade at 3 mini lots. Now, in scenario 2 that we discussed, which is what it's doing now because of news announcement, which is perfect timing, we go in right now because it's already stalling. It's trying to push, maybe whatever. Let's say it goes through. We'll see what it does. We go in, wait for it to push, wait for it to push. Let's say, okay, I decide, it's going to keep doing this for another 5-6 minutes. Maybe it'll push through, maybe it won't, doesn't really matter. Let's say, take for a quick scenario here. I go in now. All right, so boom, I have it right there. But I already knew what my stop loss was going to be right here because it needs to break this line to do that. So now I only have a 15 pip stop loss. But now I'm taking a bit more risky trade because it's moving a little bit more than it should. We know it's an announcement that I'm trading on. So now my entry strategy is, okay, I go in now, but I only take 2% risk. However, the funny thing is the 2% risk now has a much higher lot size. It's only 15 pips. And some of you are sweating right now. Would I care about the 2%? Not really. Because the profit that I can make versus what I'm going to lose, I don't really care. All right, we can take a look at it here. What could it do? Probably this top here. They could do something like that. I'm okay with that. So on a day, it just looks like this. Let me see it in a day. There. So as long as this doesn't go there, we'll be Gucci. If it goes all the way back down, okay, fine. I lost 2% of my account, right? But I was willing to make losing this versus, oops, making that 15 pip stop loss versus 150 pip take profit. I'll take it. But let's say you're not willing to take a 2% risk on your account just as, I might lose money. Then you wait for it to actually push all the way down and then you go in here instead. Right, then you do that. And your take profit is going to be underneath the closest resistance, which is going to be somewhere over here, I think. Yeah, by the looks of it, on the smaller time frame. So you would go in here, but the problem is now you have a 140 pip take profit stop loss. And now you have to go here, which is 220, 140, still 1 to 2, but it's not exactly what you want, right? But the lot size, again, you can then take, okay, now I have a really big take profit. I want to do a little bit less risk, so I cut my lot size down. In trades that are perfect entry, they're at the bottom of the trend, they're at the resistance, there's no news announcements in the next day that are going to interfere with it. It's probably going to start going up because statistically speaking, that is what it's going to do. This will probably pull back, the one we were looking at. Whoops. What is going to happen is you are consistently going to make more winning trades than you will losing trades. Right? And cut your losses is something we already discussed, right? Don't marry positions. If your position has been negative for 3 days, and let's say on average you trade about 4 days open, what are you waiting for? Clearly it's not moving, clearly it's not doing anything. Close it. It opens up equity for you to put into a different trade that might put you into profit faster. And as we discussed, you should always have multiple trades open at any given time. You have so many instruments to trade. That does bring me to don't trade gold and oil barrels and stuff like that when you have a $500 account, because the amount of pips that this trades in a day, even though a mini lot there is a micro lot because of ratios and everything else, it is way, way, way outside of your capability zone. Stocks like the FTSE 500 and stuff like that, yeah, I would say from like $5,000 you can start properly trading a bunch of those into your portfolio. But generally you start with the majors, then you add the minors, then you do some exotics, you do some stock, and then you start going commodities. Because commodities just move a very big pip size on an average daily range, usually speaking. So you want to have that breathing room. Okay. Now, for those that were with us up to this point in the webinar, thank you very much for joining me today. I hope that everybody learned something. I hope it helps, and I hope to see you for the next webinar.